you're an avid wine collector as well as the Lord of the Rings author. What's his name?
Tolkien. Yeah, I'm actually an avid vinyl collector and wine collector, and I do this thing every Friday night called Vino and Vinyl. And we open a bottle of
Nice.
wine, and I put on some vinyl records, and that's what we do on Friday nights. I'm trying to get that to become more, I would say, contagious, Vino and Vinyl, but it's both of them have aged very well.
Very
Oh
nice.
yeah.
And so I guess the hard question to the start off, is there a specific bottle of wine you favor over another? That's always the hard topic of conversation, right?
So I collect Italian wines, so Barolo and Barbaresco and some Brunellos and Super Tuscans. But there is a wine I collect that I'm probably the only guy you're ever going to meet that collects it. It's called Sagrantino di Montefalco. It's actually made in Umbria, which is where the Assisi region is, and it is the darkest, deepest red wine you'll ever get, and it lasts like it will survive nuclear wars. But it ages
Wow.
really well. It ages probably better than any wine out there. But it's because it's so big and tannic. It's the only grape, as far as I know, where the actual pulp is red as well. So if you see a bottle of Sagrantino, try it, but you're gonna probably have to let it breathe for probably about a day. It's just a big unctuous one. And after this, ping me. I'll send you a list of producers. When I started collecting, it was like 9 producers. Now there's like probably 40 or 50, but it's a great bottle of wine.
That's amazing. I love that. That's awesome.
Very cool. Could you get it in the States, or do you have to order it from Italy,
Oh
or
yeah,
how does that work?
absolutely. There's a lot of good producers. Capri is probably one of the most well known. Antonelli, Rocco de Fabri. So they're very well. A lot of places like the big stores will have them, but you'll have to like find where they put it. You know what I mean? It's like it's usually in the near the Super Tuscans or whatever. But that's my. I started collecting probably in the early '90s, and most of my Italian collection is probably 25 to 30 years old. So, and I've had some. I have a lot of friends in the industry too.
It's awesome. Some good bottles in the basement. I love it.
Oh yeah,
Yeah.
oh
So
yeah.
Jake,
Well, I'm actually at the point in my life where I'm drinking the wine, not collecting it anymore.
why don't you kick it off? Tell us about your background. Maybe want to start with your early part of your career and take us to where you're at today.
Sure. So, the early part of my career that I built my brand on was actually in equities and equities technology. So, the days at ITG, at my post bulge bracket firms, Morgan Stanley, Lehman Brothers, I went to ITG, and we were one of the first firms to actually build algorithmic trading. We had things called smart servers back then, and we turned them into algorithmic trading systems. And we were pioneers in the space, and I like to think everyone replicated us, right? So, helped build up ITG's business. From there, I went to their main competitor, LiquidNet, and headed global markets and corporate strategy. And actually, that's really where I think, if I was looking at the prime of my career in the equity space, it was built on LiquidNet. Spent 8 years there, made a number of friends, created some great businesses, built a product called LiquidNet H2O blocks, and it's we were probably we were the largest block trading institutional system globally. And I think when I started there, I was employee 99. When I left, I was like employee 500. And then from there, actually, when I mutually agreed to leave LiquidNet, I took over Pipeline. And I don't know if you remember Pipeline Trading Systems. They were also a competitor of LiquidNet and ITG. I took over them as their CEO and executive chairman after they had an SEC violation, and was able to, kind of right the plane and get the firm, sold to Portware, which is ultimately FactSet. But the thing that I learned mostly back then was, and what I put to work back then was, I actually used technology to increase efficiencies in capital markets. So, we went from, in the early 90s, where the New York Stock Exchange was doing like 100 million shares a day. When we went to electronification, started using fixed technology, we started doing billions of shares a day. And that was because of all the data we collected, and we were able to scale up processes. And when I left, Pipeline, I had a startup with a friend of mine, looking at artificial intelligence. Way early in the artificial intelligence, we didn't even call it back then artificial intelligence. Obviously, we called it machine learning. But then I got into the digital space. I started with a firm called CoinCenter as a consultant, and their idea, and this is like 2014, was to actually take this fixed technology that we use for equities and actually allow for trading of Bitcoin. And this is when Bitcoin was like 150, 100, $200.
Oh man.
We were like, we want to mainstream crypto assets. And here we are 10 years later, and we're just getting there. So it was, I think they were very early in their evolution, and they were eventually sold to Kraken. But I think really the idea back then was, let's take this technology and apply it to capital markets and eliminate these processes that I was talking about, right? If we were to eliminate some of the processes, then, we couldn't necessarily scale things, but we could actually create new ways of or making more efficient processes and eliminate a lot of risks in the market. And that's what drew me to State Street. So when I joined State Street, it was 2017. Bitcoin was just starting to make its move to 10,000, right? And I think it peaked in 2018 at 18,000 around that time before we hit the first crypto winter. But what we said was, let's take this technology, right? Like we used, data in the 90s and early 2000s to create more efficient capital markets and equities and fixed income trading. Let's take this technology and apply it to those same markets and create more efficient ways of trading, more efficient ways of eliminating risk, more efficient ways of finding alpha, implementing into portfolios. And now it's just starting to happen, right? Where, I was at State Street 7 years, and now we're seeing, the fruits of our labors, right? People are really starting to embrace the technology, right? As much as, crypto is the vernacular, it's really this technology, the blockchain technology, that makes things exciting, especially, we'll get into this obviously, but, how we can apply it in so many different areas. So
That's amazing. That's very cool. Early adopter, many different fronts: machine learning, AI,
yeah,
crypto,
if I can only
blockchain.
translate into stock picking, that would even be better. You better have an
Yes, that's amazing. So, talk to us about? I mean, today, current state, where the narrative is in the marketplace with large institutions looking at digital assets. Right? We can go a few different ways with that, but maybe just a starting point. Kind of
Sure.
talk to us about that.
So, I like to address it in a way like I look at market adapters. So we have the innovators, right? The innovators and the chasm crossers. And if you look at a wisdom tree, right, what John has done at Wisdom Tree, if you look at what the folks at Franklin Templeton have done, Jenny Johnson with Mike Muir and his team with Benji, you have these buy-side firms that have actually, they've seen the vision as well. I remember when I first met with John, it was with Securrency, right? And they were a tokenization platform. And at the time, tokenization wasn't even, part of the business vernacular, right? Tokenization has just come out in the last few years, but their vision was to do the exact same thing I was thinking about. It's like apply it to capital markets. And those, early chasm crosses are starting to see the same thing. They're starting to see the upswell in interest from other asset managers. So then you take, the chasm crossers, right? There's a number of firms out there, certainly the ones that they're putting out ETFs, the BlackRocks, as well as others, and they're embracing it. And what they're seeing is the opportunity to actually make their investment process and thesis more efficient. We worked with Symbiont and Vanguard at State Street. That's public. And, they were looking to actually take, what we proved was you could actually take a private instrument, put it on the blockchain, right? So all these ideas that we were working with in these little silos, little MVPs, are actually now starting to be embraced by the buy side as a way of the market evolving into these new assets and new asset classes. So, one of the things that I think Jono was a pioneer on was the technology being used for mutual funds and ETFs, right? And you could see what he's done with Wisdom Tree Prime. The same thing when you look at what Franklin Templeton was doing with Benji, right? Creating a digital transfer agent. So, and they created a digital money market fund. So all of these buy side firms are kind of like leading the chasm crosses, and the chasm crosses, right, after the innovators are the banks, right? So it is the State Streets, it is the banks of New York, it is the Northern Trusts, the JP Morgans, right? As much as Jamie Dimon poo-poos Bitcoin, he's got a tremendous business with Onyx, right? So it is a technology that is now finding its way into the mainstream. The biggest problem, I think, is it's not the widespread adoption, because we have that widespread adoption. What we don't have is a concentrated use case. And I think that's what's really lacking in this industry, is a concentrated use case around this technology. Now, Franklin Templeton created a money market fund, a tokenized money market fund, and there's several out there, right? Stable coins. We have Paxos, we have Circle, we have a lot of firms have stablecoin platforms, and that's being embraced as well. But if you really want to see the promise of this technology, it's going to be around what asset are we going to all adopt and say, you know what, this should be on a blockchain, and here's how we're going to do it. And there are a number of firms that are looking at that, like iCapital is looking to implement that for private assets and wealth assets. But I think the difference between what we did 20 plus years ago in capital markets, when we moved to electronic ledgers and created data around the algorithms, like I talked earlier, was the regulators drew that line in the sand. In this instance, the regulators aren't going to draw that line in the sand, right? They're not going to say everything should be on a blockchain at this point, because they're still a little skittish, right? They still want traditional books and records on, and then you could run a parallel blockchain, but they're still not comfortable with putting everything on a blockchain. So I think it's incumbent upon the industry to say, we get this technology. There are some use cases that are like cutting butter with a chainsaw that we're not going to pursue, but we need to do it around this. And it could be real estate, right? Everyone's talked about that. It could be private equity, private debt. Personally, I'm agnostic, but I think it really comes down to somebody has to show leadership or a consortium approach to solving a problem in the marketplace. And, I think, a company like DTCC kind of is in that space right now. They made the acquisition with the currency. I think there's an opportunity there. But it's also, it might be, one day, Bank of New York and State Street, we've done proof of concepts together. We'll say, hey, let's solve, a particular issue around custody or transfer of assets or, transfer agencies. So, hopefully I'm not too long-winded, but I do think that everyone is paying attention now. They're either investing in it or they're going to be looking to, the incumbent to help lead that. And that's the final piece. There are a number of firms out there where we've spoken to, I spoke to well over 100 firms at State Street. Some of them are just like, what, could you guys solve this? And, we'll be ready for it, but I need you guys to solve this. And that's the little bit of a quagmire, right? Because we don't know what we're solving yet, but we do know that we have a solution in search of a problem.
Right? Right. Absolutely. Well, I mean, what's the hang up or the fear that large institutions still have in certain cases? Where do you think that lies?
That's a great question. I think it's really, you have, I quoted business as usual is the enemy of innovation, and innovation is the enemy of business as usual. And I really didn't mean that as a caustic statement. I mean, it's because that when you're running a business, right, and you want to be able to create an entirely new business, it's very difficult to account for that from a bottom line standpoint, especially when you're a public company, right? So innovation not only costs dollars, but it costs resources as well, right? And then you have the regulators are very intently focused on what you're doing in this space, right? So it's very hard for a large firm, a G-SIFI bank to actually move towards innovation while maintaining business as usual. And in all fairness to them, we would do the same thing, right? If we're running a restaurant, we're not going to, if we have a hamburger place and we all of a sudden we want to sell quiche, well, that's a big leap of faith, right? So, but I think that's the biggest thing. It's really around resources. I think the technology has proven itself enough. But what I think will start to happen is you do have the fintechs, and I wrote an article about this years ago. They have the luxury of not having business as usual, right? They have the luxury of being able to just concentrate. And that's kind of what we did at LiquidNet and ITG. We said, we're going to go after these guys and they're going to eventually change, right? They actually changed their models to represent us. So I think you'll start to see that. But I think at the end of the day, it really comes down to what I said earlier. The use cases are kind of very very scattershot right now. It's like if you go to one firm, they're like, we're gonna tokenize league tables, right? And if you go to another firm, we're going to tokenize indexes, and the other ones are going to say, yeah, we're going to tokenize mutual funds and ETFs. And there's a lot of like possibilities, a lot of opportunities, but let's pull back a little, fellas. Let's just say, listen, this is what we're going to do. And I don't know who that leader is, right? It's like I said, it's not going to be the regulators, but I will probably lean on what I said earlier. I think it's going to be the institutions, the buy side institutions, because they know where their costs are. They know what they don't want to have to deal with, right? And they're going to say, solve this for us. State Street, Bank of New York,
Yeah.
Northern Trust, JP Morgan,
What do you think is the lowest hanging fruit in terms of digital assets tokenization? Kind of for these institutions.
In terms of what, an asset class that could be tokenized, or an opportunity for them to make
Yeah, I would
something
say
more
in
efficient.
terms of like tokenization, in terms of innovation for these big traditional financial institutions that so far haven't really like we've been talking about, like taking that next step into the digital asset space. I guess what do you think is kind of the low hanging fruits for, yeah, let's say
Yeah. So
tokenization?
outside of investment, like moving into DeFi and investing in certain tokens, I think it really comes down to tokenization of the mutual fund class, right? So the mutual fund class and the ETF class, both of those, the mutual fund class has been contracting for years, right? People don't invest in mutual funds the way they used to. ETFs have been around for 30 years, right? And they are the most attractive asset to any number of constituents. There's a constituency that is completely removed from mutual funds and ETFs. It's that constituency that uses Coinbase, that uses Gemini, that uses that invests in digital assets, and that constituency is looking for an asset class that they could trade on a chain and move seamlessly in and out of. Right. So if you think about people that invest in tokens, and they don't have much cash flow, right? So if you were to put some a treasury on a blockchain, if you were able to move that treasury ETF or that treasury mutual fund seamlessly between an ETH or a Bitcoin, you'd start to see an incredible amount of interest there, right? So, we all invest in crypto in here, right? We know how easy it is to move from ETH to Cardano to Bitcoin. In the traditional world, that does not happen, right? I can't move between equities without a lot of friction, right? I have to sell out of one and buy into the other, let alone moving to different asset classes. So as those asset classes start to get represented on the blockchain, people invested in. So I think the low hanging fruit is exactly what I had said earlier. It's the mutual fund, it's the fund complex. It could be the hedge funds. It could be any type of fund structure can be easily replicated on a blockchain. And you could actually run you could run traditional ETF and you could run a blockchain ETF. And I think that's really where the low hanging fruit is. And that's where I think if you look at the hundreds of buy side firms that are out there, that's what they should be looking at, and that's what they should be looking to take advantage of. Because one, it's going to increase their constituencies, so that people that can invest, but it's also going to eliminate a lot of friction in the market, and it's going to attract new investors. And that's exactly what a lot of these ones that mentioned earlier are looking to do.
That's great. Yeah, that's interesting too. Just obviously, so that narrative of tokenization, the low hanging fruit is interesting, but also just thinking through that operationally, right? It creates operational efficiencies for the sell side
Oh
as
yeah.
well downstream. Which I don't know if I'm curious what your thoughts are on that. Those efficiencies that are coming to play with putting something on chain.
Yeah. So
Yeah, I think
blockchain is.
like you mentioned
I've
like
said.
DTCC, like that. I feel like that's a big opportunity.
Oh yeah. I've met, I've said this ad nauseum. Like, listen, there's two things blockchain does: validates ownership and transfers value. Right? That's very simple. That's what we do all day long. But we do it in so many iterations that it becomes costly. Right? So once you eliminate a couple of those processes, transfer agency is essentially validating ownership and transfer value. That the regulator should come out and say, you know what, we want you to apply blockchain to transfer agency, and it would create such a groundswell of support from a lot of people in the space. Now it will make it cheaper, almost eliminate that cost, But then you have to say, okay, what's the other opportunity around there? So a lot of these, transferring value or moving from one asset class to the other on a blockchain is so simple. I mean, it really is. And doing it atomically instead of waiting 2 or 3 days to settle and move cash and everything that comes into play here. Doing all that on a blockchain will just eliminate a lot of the friction in the market and lower risk. That's the biggest thing. It lowers risk. If you think about counterparty risk and settlement risk, that's the two biggest risks of trading at this point, right? Doing it on a blockchain, it's virtually eliminated. It is completely, I would say, 99% or 95%. If the regulator's listening, there have been a number of proof of concepts. Certainly, we did one with Paxos, right, doing atomic settlement using their equity pilot, and it's been proven. So I think where it comes to transfer agency, settlement, even movement of cash, right, geographically movement of cash, that's just something that's just crazy. That it's how much friction's in that market. So, like I said, these have been proven. I think what'll happen is you have firms like Finality, right, that are out there offering geographic payments. And then you have firms like Paxos, firms like Circle that are out there trying to create these platforms for institutions to eliminate the friction in the market, gain efficiencies, and even before creating new assets, right? Because that's a whole nother conversation, using this technology to create like tokenized data. Tokenize the royalties from Bob Dylan's portfolio, right? That's a crazy opportunity. And I love talking about that because I think that's going to happen sooner rather than later. But again, I get accused of being the science fiction sometimes too much, but the process is in and of itself. iCapital, we did a proof of concept around moving data on the blockchain. And it worked perfectly well. So I think, you'll start to see that as well. A lot of infrastructure plays in the blockchain space.
How about in terms of the chains that these different institutions are looking at? When we think about putting mutual funds, things like that on the blockchain, are they looking to use something like Ethereum, or are they looking to build, more of their own internal blockchain?
Yeah, so the biggest problem, well, not the biggest problem, the problem when you have like a large bank like a State Street or JP Morgan is you can't do anything on a public blockchain, right? The regulators are very skittish about public blockchains. So what you'll have to do is you'll have to look at more of these level 2 blockchains like a Polygon. But I've seen a lot of work done on Stellar. I was surprised how much work was done on Stellar, and one of the reasons is the gas fees on Stellar are very, very cheap compared to doing it on other blockchains. So yeah, ETH is going to ETH is the godfather, the big one everyone's looking at, but it's really going to be like a Polygon under ETH that people will start embracing. And some people are using NFT technology, which is another Polygon use case to do bearer instruments, which is very interesting. So, but I do think it's really more going to be it's going to be like the well-known ones, right? The Stellars, the ETHs, because I think ironically, I think people are comfortable with them. You mentioned proprietary blockchains build their own. Nobody wants to do a proprietary blockchain unless it is like something comes out of the woodwork and it's a eureka moment. Because one of the problems with private blockchains, it kind of locks you in to who you're working with. So,
Yeah.
if you think about Red Hat, right? Red Hat has a great business doing Linux. Linux is a public technology, but they're the consultants, right? So they make a ton of money on something that's virtually free. I think that's what you'll start to see. I think you'll start to see more expertise coming out of a Red Hat type company. I'll use Securrency, for example. They're basically blockchain agnostic. I think the idea of interoperability has been solved. I don't think there's much worry about interoperability. So it's really going to come down which blockchain is fastest and cheapest to operate. And I think I would lean towards Stellar right now being the one that I've heard the best things about.
That's great. That's
Yeah.
excellent. I guess you mentioned regulations briefly, but from a current state of the landscape of regulation related to technology and kind of where things are at, what are your thoughts from an institutional perspective? How are they viewing it today? Current state. I know there's a lot of noise in the space, obviously, with regulations and where things are at, but just to get your thoughts on that too.
Yes, I mean, if you look at let's talk, obviously getting approval for the ETFs is one just part of regulation, right? So having the SEC approve all those, and then you're probably going to see ETH and other, blockchain type of single asset blockchain ETFs, and then subsequent to that, you'll start to see more indexes and incorporate them to more sophisticated portfolios. So that part of the equation is solved. Just getting the regulators comfortable with each issuance. The biggest problem in the market, though, is really going to be how regulators view these assets, where, especially on the crypto side, because once you move off of ETFs and now you want these institutions to invest directly in them, right? That's going to require a couple of things. One is you're going to have to get more information, right, to the portfolio managers to model these things into it. But you're going to have to get the regulators comfortable with what they want to do. There's no reason why, somebody who's doing a crypto, I'm sorry, an inflation hedge is not able to invest directly into Bitcoin, not just ETH, but directly into Bitcoin, because it's been considered an inflation hedge, right? And you could create a portfolio with physical gold or physical Bitcoin. That's an oxymoron, but you know what I mean? So I think that's, being able to directly invest into these assets is something I think the regulators will have to address. With that comes their comfort around hacking, right? I think that's their biggest thing. Protect customer protection. How do you protect your customer? Now, with the ETFs, it's easy. The customer's protected because they're arm's length removed from actually being holding physical Bitcoin. But once you start saying, okay, I want to hold carbon credit tokens, right? Instead of just buying carbon credits, buying carbon credit tokens and holding those, I think that's going to get the regulators comfortable on that. And that's going to be, I think that's going to be an iteration by iteration. I don't think there's going to be one sweeping thing saying, hey, we're happy, tokens. And then the other pieces of it around less about regulation and more about the custody piece of it, right? Because there's thousands of tokens, right? And we know not everybody's going to be able to custody every one of those. I think that's something that the banks are going to have to solve for them, or the custodial institutions, right? So you have the Geminis and the Coinbases that provide custody services, NYDIG. So that has to be solved. And the final piece of that is when you think about what happens with custody. It's not custody's there's nothing sexy about custody, right? And there it's you stick something in a drawer basically, but it's what institutions or banks do with those assets, right? So being able to rehypothecate, do sec lending, right? That's the thing. That's the reason clients come to these large banks. It's to get those other services, to get more alpha, and that piece of it, like getting people to understand staking, is really difficult. I mean, try and talk to somebody's been in the business 30 years and they don't get what staking is. And then you say, you know what? It's kind of like sec lending. Like, oh yeah. And like you try and convince them what an airdrop is. They're like, oh, I'm like, it's kind of like a dividend from a third party. Like, oh, okay, I get that. So I think those little pieces of it are going to have to be, I think the regulator is going to look very closely at that. I would love to be a fly on the wall when regulators are looking at staking. Because it's to us, it's a simple concept. To them, it's like, so you're giving somebody your tokens to use. So, but it's just like just like sec lending. That's really what it is.
Yeah, you're exactly right. I always think about just even I started my career in the 40x space, mutual funds and ETFs. I always love to be a fly on the wall in these board meetings. Just even from like an insurance perspective, the first time they talk about digital assets and how they perceive that risk appetite. As we obviously ETFs are already filed and approved. But to your point, as more things come their way, more nuances with the space, there is definitely an educational process that needs to go forward for a lot of people, right, to catch up.
Yeah, and there, like I said, there are a lot of them that don't want to be able, that have to want to think about it. But I do think there's a big opportunity. Certainly, one of the things I'm looking to do is to talk to institutions, and maybe even talk to RIAs and family offices just about what they are. And it's funny because if you talk a lot of these family offices, they're already there, right? They didn't have the regulatory issues of a traditional asset manager, but getting them comfortable with, like, they're the ones that don't understand the infrastructure piece of it, right? Whereas the banks get the infrastructure piece but don't get the asset piece. The smaller family offices and endowments get the asset piece; they don't get the infrastructure piece. So there's a lot of education still to be done in the markets.
Yeah, I guess on the RIA side, what do you see? That's an interesting market, right? That's a huge opportunity for a lot of the ETFs in general as well. Where do you see the RIAs kind of going with their thought process?
Absolutely. I mean, there's a huge upswell in interest, certainly around the Bitcoin ETFs. And I think that's really where you'll start to see more innovation on their part, or more investment on their part. I protect my own advisor, right? I've spoken to him a number of times. He still doesn't know what I do. But he kind of gets, what it is and how he can incorporate it into some of his portfolio modeling. So, and then just, there's a lot of singular managed accounts, right, that are looking into the space as well. A number of asset managers looking to that as well. So I think that kind of middle tier of investments is going to start to see a lot of investment moving forward, because they're the ones that really were the original investors in ETFs, right? They saw the opportunity way back when. And now, they're going to see the same opportunity in what the next iteration, and that's what I hope. I'm not getting too far ahead, but I think there is going to be a new instrument out there, and it's going to be ETF like, but it's going to be a completely new beast, and it's going to be based on the ability to do something 24/7, as opposed to your traditional 9:30 to 4 market. So that's exciting, I think, for me. And when I try and talk about that concept to certainly my advisor and a couple of our RIAs, they kind of get it, because they're like, yeah, because exposure, like even 2-day exposure over the weekend, is something they don't want to deal with. But no one wants to deal with a 24/7 market either, right? So we
Right.
have our
Yeah,
boundaries,
it's
and then those boundaries are going down.
double-edged sword for sure. What are your thoughts on the next ETF? I'm curious. What do you think in terms of the future of ETFs?
Yeah, I do think, and yeah, I could throw caution to the wind right now because I'm a free agent. I do think ETF is an exchange traded fund, right? Mutual funds are funds that are very stagnant. Exchange traded funds have a lot of velocity, but that velocity is very compact, right? So, especially when you're dealing with a physical related ETF, like you would with a Bitcoin, and I use the term physical because there is a separate market for that, but just like gold and silver, it carries exposure at certain times. The ability to actually package assets in the same way you do an ETF, but instead of being limited, you could actually move those assets, um, you know, in the middle of the night, right? If you're in the East Coast, or at 24/7, it will require two things. One is that new market to develop, which will not be an exchange um, as we know it today, but it will be a marketplace that operates 24/7, like the crypto markets do, right? That's what, when you point to what Coinbase does, and if you point to what, all these global exchanges do, one is they're basically just 24/7 markets. They're basically global markets, right? There's no geographic boundaries. And then if you add an asset class to that, that is a traditional, closed market, and you start trading that 24/7, then you start to see the ability to package those assets into, whatever this ETF thing is. And then it becomes, you're not bound geographically either. You could package any asset that's tokenized into a fund that's tokenized as well, and be able to, you know, move that asset at any given time, or invest or create and redeem at any time. And that's really where the promise is. And that's, Nasdaq is, I think, got out of the custody business, but they're looking into the crypto trading business, the digital trading business. And if you think about, Coinbase has what a market cap is, I think, north of 100 billion today. And then you look at some of these banks whose market caps are like 1/5 of that. It's not because they're going to be trading Bitcoin in 10 years. It's because they're going to be trading all assets in 10 years on the blockchain. And that's the promise of this new instrument, this new marketplace. And then you start to say, okay, now you have traditional assets. Then we're moving, the illiquid assets like the real estate, the private debt, private equity. You're starting to eliminate friction there. They're trading in this world. And then you have the idea of all new asset classes, right? Tokenization of data. I've probably said this, to 1,000 people. Data is very valuable, right? We all have Gmail accounts. It's especially valuable. And from working at the TIE, people want to have data around these assets, but that data in itself could be an asset, right? Imagine like, um, you know, Google is $1 trillion company, not because they give away free email, right? It's because they have all the logistics attached to it, right? So being able to take those logistics and package it in a way where say a firm like IBM or any other Fortune 500 company could actually take that data and resell it. Well, now you have a whole new balance sheet entry, right, and market cap. So that's the promise, I think, is these new asset classes. And then there's things people haven't even thought of. I haven't even thought of yet that will become
Yeah.
asset classes in the future. So
I never even thought about tokenizing data. How elaborate on that? I'm really curious. Is this like something that you've seen, or kind of just something you're thinking about in the future?
okay, so it was I have been thinking about it, and I've also met people who are also thinking about it who are actually implementing it. So let's use uh, let's use Google as an example, right? So Google has Gmail, and Gmail looks at everything we do and is able to package that data and sell it, right? To or even Amazon. Amazon is a logistics company. It's not a retail company because they have all the data. They know when I go in there, I'm looking for vinyl, so they make recommendations, right? And they know, Gmail knows through what you're getting in your email, and they're repackaging that data, and they're making a ton of money off that data. Well, switch that paradigm, right? Say you don't own that data, I own that data, right? And I'm actually going to take that data and tokenize that data. So I'm going to actually take the information and use a smart contract to put it into a token. Now, no one may not want your singular data, Mike, right? But if you have all the data of the brokers on Wall Street, or you're starting to create sectors of the state, that becomes very valuable, right? And the best way to protect it is through tokenization. And then now you have a marketplace. So individual data, probably not, but you think about a large mutual fund. Let's use Wellington, for example, right? So Wellington has a tremendous amount of information, right? Ton of data. Um, there's a certain amount of data that they could repackage and sell, right? And if you could value that data, then you have a balance sheet that says, okay, this data is worth X. Then you create a marketplace around that. So it's no different, and you will have a portfolio of data that you could, apply a value to, or net asset value to. And you look at the balance sheet today, it doesn't exist, but you look at the balance sheet in the future, it's probably billions of dollars worth of data that you could put on a balance sheet because you could value it, right? It could be sold and resold. There's a market for it, and it's a far better value. It will be far easier to value than goodwill, right? Because goodwill is
Yeah.
whatever people think it is. So
Yeah.
so that's the thing, and I think really where that paradigm shifts is when you start, when people start reading those little things when they sign up for something, they hit agree. I think people
Yeah.
start looking at it a little closer.
That's
Yeah.
interesting. No, that's pretty cool thought process. I do know a couple groups actually, and this is a great conversation because I think people tokenizing assets, they forget the underlying data that's associated with that. So now you have an on ramp off ramp problem, right? Of going back and forth, even from a service provider perspective. You have your asset data, but if it's not tokenized as well, it's separated. So you're still in the Web 2, Web 3 process, right, on both sides. So I know other groups like Dwellify and others out in the space are tokenizing both sides of the equation. I'm sure others that we talk about are doing the same thing. But yeah, it's an exciting thing. Even kind of going back to what you talked about, you mentioned mutual funds and ETFs, where these interval funds and tender offer funds that have limited liquidity, limited redemption schedules. Now you have a technological framework that can mitigate that, from an asset class perspective and what they're underlying, what they're investing in. Now that really creates some efficiencies and
Exactly.
liquidity that wasn't there before, right? So these hybrid vehicles that are out there, they're kind of quasi-private, quasi-public, if you will, on how they're registered. That can help those. I'm curious to see how that develops with products down the road too.
Yeah, I mean, if you think about like how people are tied into hedge funds or other, private assets, and if you have a tremendous amount of alpha, right? And how do you get out of it? Well, you can only redeem at certain times according to the agreement. But if I was able to take a portion of my assets and then I tokenize them, right, and then I issue them, then I'm just basically creating a vehicle where I've gotten my value. It's no different than home equity loans, right? I think home
Right.
equity loans, tokenized home equity loans, there's a number of firms looking at it. It's so simple. It makes perfect sense. I mean, if you've ever gone for a home equity loan, you go through the package, you go through the same thing, the search and everything. But if I want to be able to get some value out of my home, why wouldn't I just be able to, hey, I'll sell 10% of my home on the open market or to somebody and I'll do it via token.
Yeah.
And there are people looking at that. So I think that's really where, these aren't crazy ideas. They make perfect sense. You know what I mean? It's like, why wouldn't I be able to like get a home equity loan just by pressing a button? I go to Vertalo, I tokenize a piece of my home, I do an issuance. Now, I'm not, I don't think anyone's going to buy mine personally, but a bank might say, hey, yes, I will buy those tokens. And that's really where the market is, right? The market's going to be not from individuals, but it's going to be these institutions saying, yeah, I want to invest in, a certain commercial real estate here. Want to buy tokens, and I think Invenium, right? I don't know if you've ever spoken to the
Yep.
guys in Invenium. That's their whole premise, and it's a great
Right.
premise. It's just you got to get the flywheel turning. You know what I mean?
Right. Well, to your point, the data, if you have the data, like think about the underwriting process, how streamlined that would be, because they have everything then at that point in time. If they have the data underlying from the loan and everything else kind of packaged up, that makes things much easier.
And underwriting is just mitigating risk, right? And that's what we said. Blockchain mitigates risk. So essentially, that's a great use case. And I think that brings it all the way back to like why mutual funds and ETF issuers are looking to do that, because the ability to create, underwrite, and issue assets is so much easier on a blockchain, and you have many more constituents, better price discovery, more liquidity. It should make so much sense. And then, add on top of that, the, eliminating settlement and counterparty risk. It's like I bang my head against them. I'm like, why is this so slow? You know why it's so slow? it's This is an interesting metaphor. So when I was growing up, the only way you complete, everyone plays lotto, right? You pick three numbers. Well, growing up, that was illegal. All you could do that is to go to Mr. Pepe at the deli, give him the three numbers. You know what I
Right.
mean? So when they were approving lotto in New Jersey or lotteries in New Jersey, they were pissing off, the mob. So if you think about how these markets work, there's a lot of people make a lot of money every day by keeping status quo. And
Very
I remember selling algorithms back in the early 2000s, getting kicked out of offices because these guys are paying a nickel to their buddy at the New York Stock Exchange that's taking them out to the masters. And I'm like, we could do that for 2 cents. And they're like, get out of the office. So it really comes down to the status quo either has to retire or just embrace this technology.
Yeah, for sure. This is great. I was curious on a couple of things. Obviously, we talked about efficiencies, a lot of use cases here. From a post FTX capital raise perspective, how are people looking to raise capital? Today, the current state. What anything that's unique that has changed with the new paradigm? Just curious what your thoughts are, what you've seen.
Yeah, so I actually had this conversation the other day. I would rather be a new firm that was founded in the last 6 months looking to raise capital than a firm that was founded 6 years ago looking to raise capital, because
Interesting.
two problems there in the older firms. One problem is if you do not have a return that you promised or even close to that return you did, your last two funding rounds, it's going to be difficult to raise more, right? So, but the market kind of was in the way of doing that. The other thing is that your valuation is going to drop. So it's really, I think it's kind of the newer firms, the newer ideas have an advantage at this point. That being said, there are some great firms out there that are doing very well, and they've met their goals. They have actually rolled out. So it's kind of I think a very unique situation. I think valuations are always going to fluctuate, right? That's true of any private market, startup market. I do think more and more firms are meeting their goals, meeting their revenue goals, and I think it's easier to project now what the institutional uptake, because it's all based on institutional uptake, right? It's easier to predict now on an institutional uptake because they're looking at you and they understand that. So fundraising is always a sticky wicket, but I think the advantage is if you have a good idea, it's a great time to be in the space. If you have been able to, get through this crypto winter and show growth, you're going to be in good shape. If you have not been able to show that growth and you have been able to get that revenue, then it's difficult. But that's
Yeah.
I'm just stating the obvious, right? So
Sure. No, that's helpful. That's great insight there.
One last thought I was thinking about from our notes here, the rise of DeFi in institutions. Have you seen institutions interact with the DeFi space, and kind of how are they thinking about DeFi?
Yeah, so you have a lot of innovators that are trading DeFi, and I used to say, if you're still looking at it, Bitcoin and ETH, you're so 2020, because it's really all about DeFi. And their firm, there are a lot of firms, and that's the most. I think that's the hardest problem to solve right now with a lot of the incumbents is how do you like provide services around DeFi because it is essentially decentralized finance, right? So you can't point to one valuation or another. And then when you started getting into, SAFs and other derivatives, it's hard to value it. So, we ran, fund administration at State Street, and this is true of every fund administrator globally. So I'm not just saying State Street. They're all having a difficult time in this space because it's very difficult to get that singular flat picture at any given point. But on the other side of the equation, institutions that have been in this space are going crazy in DeFi. There are a number of really good firms out there. I could name, the Quarry was one of the early firms looking at DeFi. They understand the space. They see the opportunity there. And I think that's going to be a very, very interesting next 6 to 12 months with DeFi. Because I think institutions are going to they're going to understand crypto a little more. And then they're going to say what other opportunities are out there. And then they're just going to look at this screen with all this, information on it. And they're going to be like, wow, what are we doing? So, and I know the regulators are probably going to be even, going crazier on that. But there are, I'd say, the most of the more astute hedge funds are in the space already, and they're heavily invested in the space.
Yeah, absolutely. What are you most excited about project wise, or just some initiatives that you're seeing that we haven't talked about to this point? Just curious, going from 2024 maybe into 2025.
I think the custodial opportunity is huge and profound. I think there's still a lot of juice in that market to steal a term from one of my erstwhile colleagues, because nobody is doing it in a way that I think institutions are used to or comfortable, right? So they're used to how State Street does it, how Bank of New York does it. So I think that's a huge opportunity. Trading is also a big opportunity because once institutions trade differently than retail markets, right? When I was at Liquidnet, there's block trading. There's the idea of the OTC market. And most institutions trade OTC, I think still. I think last time I looked, it was like 60-40 trading OTC. So the trading markets for institutions is an opportunity. And then there's tokenization. It's near and dear to my heart. I think the ability to, create a tokenized market, whether it's an ETF market, whether it's a private equity market, is profound. And I do think you'll probably somebody's going to raise their hand and say, listen, this is what we want to do. And the institution's going to say, yes, do it. Because they're the ones with the problems when it comes to private, right? They're the ones that have the most friction. And they're going to say, yes, use this technology to do that. So that's what I'm really excited about. So it's all of those and so much more. I mean, I love talking to people about this stuff because once they get that eureka moment, they're like, yeah, I get it. And I think I want to give a little props to you guys because I think when you think about like what the TIE is doing, the opportunity to provide data in a space is also a greenfield, right? There is not, we grew up on fundamental and technical research. Well, crypto has a completely different, unique way of providing data, right? And that's a thing that people, institutions need the most is like, what do I know? I know how fundamental data works. But we can't apply it to crypto. I know how technical data works. Yeah, but everybody uses technical data, right? So it's that new type of data, that new insight to these assets that I think is a greenfield as well. So
Yeah, absolutely. A lot of there's on-chain data. There's not a lot of well-defined fundamentals, so
exactly.
still a very interesting space. Anything else on your side you wanted to bring up or talk about? Either of you guys?
No, this is great. I appreciate you having me. It's an interesting time in the space and an interesting time for me personally. It's exciting. I think that outside looking in, it's I think a lot of the ideas that we've talked about for the last 4 or 5 years are coming to fruition. And I think, the benefit of, we're all going to benefit from this. And there'll still be some pitfalls. There's always going to be an FTX, right? There's always going to be something out there. But I think a lot of people have understood that the reaction to that market is shorter and shorter, right? So as some of these, and I wouldn't say bad players, but some of these market events happen, I think the reaction is going to be shorter and shorter, and that's because you're going to see more people in the space, right? And they're going to get it, and they're not going to let the market, fade. There's going to be participants, and I think you'll start to see normalization with other asset classes, eventually. And like I said, it's an exciting time, and probably the best time for this space, certainly in the last 6 years.
Yeah,
Yeah.
definitely. A lot of exciting things to see come to play. We've been talking about this for a long time in digital assets, right? To your point,
Yep.
you've been in it early on, and you know, this is definitely exciting to see kind of the tide has turned a bit in our advantage.
Yeah. Real world use cases. Awesome. Well,
Yep.
Jay, this has been a lot of fun talking to you. I've learned a lot, had a great time. Where can people go to connect with you?
Just hit me on LinkedIn, and I'm readily available to talk to people. I think what I want to do is I want to continue to have these conversations, and I'm more than willing to sit down and give people some ideas. And let's face it, there's a lot of opportunity out there, and I think you're going to see a lot of investment in the space. And I'm happy to speak to anyone who wants. But hit me on LinkedIn, Jay Biancamano, and this was great.
Awesome. We appreciate the
Awesome.
time, Jay. This has been a great conversation.